GCB Capital is forecasting inflation could climb higher this month and in March to 26%. What are the factors you base for this projection?
Well, yes, largely base effects. And of course, we've seen start of the year, CD relatively stable, but still similar in depreciation we are seeing across. It's dicey, right? Because the fundamentals do not even support the kind of relative stability we see. But given the inflows from late last year, co-syndication loan to 600 million from the IMF to some monies from the World Bank and all of that, we were having close to $2 billion, to cushion our reserves from the start of the year, really. And the expectation was that that would have supported the CD to some stability. We are over 2% depreciation year to date. Not alarming compared to same period last year. But then those are undertones that could fuel inflation. There is also the base effect. If you remember, inflation started receding from January last year. So January, February, March, there were declines, and it got sharp as the year went along. Now, just the mathematical formula of inflation and looking at how the base could impact it tells you that you could see some marginal uptick. We've seen, it was a surprise though, January, a marginal increase when actually the expectation across the market was a marginal decline. And from the simulations I have done, the base effect could drift inflation even higher for February and March. And then we will begin to see a decline again from April. Now, the March print could go even much higher, more pronounced, and we could see inflation climb to around the upper 25 or even touch 26 at some point before it starts receding again. But when it starts receding, it will be at a sharper pace, and we should get into under 20% inflation before end of the first half of the year.
Yeah, I was reading an article from the African Development Bank essentially saying, is this Africa Macroeconomic Performance and Outlook 2024? Essentially saying that Ghana will continue to have exceptionally high interest rates, higher than Africa, the Africa average inflation. And that obviously puts pressure on the economy. I want your thoughts on that and what you would recommend to curtail that.
Well, interest rates are already very high. Nigeria is still an inflation problem. The inflation rate is tops 28, 29, approaching 29 now. But their policy rate is a lot less. And across many other economies, that is a reality. Even after the 100 basis points adjustment, we're still at 29%. And with the trajectory of inflation now, and if you like, the marginal upticks we expect in the next few months, probably the March policy rate decision will not be a window to even cut rate, because then you would create some confusion in the market. And I think the Bank of Ghana will be a bit more cautious in March to try to sustain an outlook of continuous decline before even making a decision. And in any case, you don't want to distort the market with very sharp cuts anyways. And so, yes, in my estimation, we expect maybe between 400 and 600 basis point cut in the policy rate for 2024. And that will bring rate to around 24% by end of the year. And if my expectation that inflation will be around 16.5%, then of course there will still be a huge positive real monetary policy rate gap. But that is just really an exercise of caution first under program, and to ensure that we firmly anchor this inflation to the target path. And that is why interest rate, I think, will be a bit high. On lending rates, they've been generally around 26, 27%, even when inflation was so high. I mean, the 54 and those levels, and even when policy rate was in the 30%, lending rates were under 27% or largely around that level, really. And I don't think the cut in the policy rate, at least the 100 basis point, would do much to change that now. Policy rate would have to fall significantly close to that or even below that for banks to even consider lowering, if you like, interest rates. in the short term, really. So we are largely aligned that interest rates, yes, declining, but will largely remain high compared to our comparator countries around. T-bill is where we have the chance to make some gains, but even that, the decline will not be as sharp as probably we are all envisaging. And you can see the trend so far. It's a marginal decline. And that's because investors have taken negative real returns for a long time. And given all the risk, the concerns, and the Treasury's appetite, you would want to be careful. And until the conditions firmly align, you won't accept so low a rate. And that is the trajectory I believe we'll see for the remainder of 2024.